Excellent. Well, thanks everyone for joining here on a Saturday. I always say if you're able to make it to a Saturday webinar, you're probably pretty dedicated. So so good morning or good afternoon, depending on where you are. It's an afternoon for me here. I'm in Switzerland right now, but just did some snowboarding this morning. But anyway, let's get started. As you guys can see, the topic here is options credit spreads for monthly income. I'm just curious, how many of you, I promise this is not going to be one of those constant Q&A kind of things, but just to kind of get people involved, I'm curious how many people have it as part of their goal. And I say part, it doesn't have to be your entire goal, to generate some sort of an income from your portfolio or from the stock market. Yeah, type into me. And I think honestly, there's a lot of people in here. I think if you really are honest with yourself, most of you should probably type in yes, because most people are looking for that as a goal. I'm not saying it's your only goal. I'm not saying you're already doing it, but I'm saying, maybe it's a goal of yours. Yeah. So um, I have found through the past 21 years of working with traders and investors on both the institutional side and the private side that a lot of people, in fact, most investors have that as part of their goal. So there are a couple of obstacles though that people face when they try to do this, particularly when they try to use options. And what I found is that a lot of people that try to generate income, really what they're doing is they are using option strategies that are ill-fitted to actually achieve that goal, which isn't very good. And the other thing is they're just not looking at the market the proper way. And I'll teach you exactly what that means in a minute. So I think there's two things one need to do in order to be able to make this work from an income perspective. Is number one, start to look at the market in a different way. And it's very simple. I'll teach you that in a minute. And the second thing, you need to actually use a strategy that has an actual good chance of producing income. If your strategy right now to generate income from the market or some sort of a positive return on a steady basis is to trade chart breakouts, I can promise you that's not going to work over time. I can guarantee you that that's not going to work over time. So you need to do something different if you want to look at for more studies. And by the way, when I talk about income, I mean some sort of a positive return on a month-over-month or at least a quarter-over-quarter basis on your portfolio. Right? We're not talking about pie in the sky, ludicrous, swing for the fences kind of strategies. We're talking about some positive return that you can have for whatever reason you want an additional source of income. The average millionaire, by the way, has in the United States has 7 sources of income. I'm working on income source number 6 actually now. So I'm hopefully soon going to be on that 7 income source. But I think everyone can use additional source of income. Now, before we get into actually the strategy, I thought I would take a minute to kind of give you some perspective on where we are in the market. And this is a very, very, very simple chart of the S&P 500. But the chart stretches back all the way to the lows in 2009. And what's happening right now, or what has been happening, is this overshooting of the long-term trend. Now you have to ask yourself, after a 10-year point in the cycle, 10-year expansion in the U.S. economy, is it really now the time to break out of this long-term uptrend to the upside? The odds are almost 100% chance it won't, right? Now, that's not to say that we have to fall apart here and fall into a financial crisis, but the odds are extremely high that ultimately at some point, whether it's this year or in the next year, we're going to mean revert into the middle or probably even towards the lower part of this range, right? Just to give you a bit of an idea on that. And again, that's in addition to what we're going to talk about here in a minute from a strategy perspective. The other thing is in terms of the broad market. So I think a lot of people have kind of come used to the idea of a 10% return in your portfolio, and I should say portfolio. I should say the S&P 500. And I'm going to say not so fast. Why? Because here are some facts on the S&P 500, just to kind of give you some basic perspective. The average annualized return over the past 90 years in the S&P is about almost, let's call it 10%. The trouble is that over the past 10 years, so the past decade that we just exited a few weeks ago, the S&P has returned closer to 14%, excuse me, 14%, which basically means that that's been a 40% more of a return than we've seen in the past 90 years. And so when you bring those kind of returns forward over the course of a decade, then what tends to happen is that the next decade, like the one we just entered basically, is going to look vastly different. So the odds are extremely high that we're going to have returns that are dramatically lower, like 50% lower, like talk about 4 to 5% return on the S&P 500 over a 10-year, over the next sort of decade. So that's kind of what we're looking at right now. Just to give you guys a little bit of perspective on kind of where I come from, I originally come from more of the institutional side of things, places like JP Morgan and hedge funds, family offices. And what I'm going to show you guys today is something that I've done for my whole life. I've learned it and at those institutions and continue doing it for clients of all types. So it's not something I came up with sitting at home on my sofa in my underwear. Excuse me for the visual, but it's true. It's not something that I just came up with randomly, which I think a lot of strategy, unfortunately, that I see touted out there is kind of falls under that category. This is actually works now, and I'm not only going to show you how it works today, but also going to prove to you that it works, which I think is always refreshing. Now I'm going to skip a couple of slides here just in the interest of time, but I do think it's important to understand that it's not about making it too complicated when it comes to trading and investing. Now, let's talk a little bit about, just to kind of give you a start and give you some perspective in terms of, let's take a 12-month return on the S&P 500. And so we took a 12-month period here. This is kind of random, but I want to prove a point. And so in this 12-month period, and we broke it down month by month, you can see the S&P returned, had big up months, it had big down months, and everything in between. The problem is that this kind of a return stream isn't very conducive for you to generate income. Does that make sense, right? If you're looking for an income stream, you need something that's less random than this. Even if the S&P at the end of the year is up, what happens is for people who have strategy that this kind of return stream, it's not only is it financially a problem, the bigger problem is psychological. They have a really difficult time being able to actually stick through the ups and downs of month to month. Who can relate to that kind of thing? Give me a quick yes. So what we're looking for is a steadier stream of income, right? I know, you can see, like, for example, we made 67% that year, but the point isn't necessarily the amount of returns you can make, it's that it's less crazy in terms of the ups and downs. So the reality, unfortunately, is that most strategies that are out there that are being taught are very closely tied to the S&P 500. To give you a very simple example, just look at what the returns are and how the correlation is on funds when things get more volatile. It basically goes to 1. Like, everyone does the same thing, which tends to be not very good in terms of performance. A lot of people's P&L curve look like this, and you're saying, what the hell is Serge? You're showing me a picture of a mountain. I'm talking about the mountain range. So a lot of people fall into the category where they make a little bit of money, then they give it up again, then they make it a little more, and then they give it up again, and basically treading sideways. They're treading water, and that's, like I said, not so much necessarily only a problem from a financial perspective because you're not making money. It's a psychological problem. And I think a lot of you, if you're honest with yourself, you can probably identify with that. In fact, you all should identify with this because you've done this before. I did this for a long, long time until I changed something and I started learning this strategy on the institutional side. So, or a lot of people maybe just fall into this category where you're just kind of, making money on one good trade and then you lose it all again. So neither of that is very, very, very fun. So what I've learned over the years is that traders, and it doesn't matter whether they are on the institutional side or you at home, you have a need to generate a monthly income just to be able to stay in that game. So I want you to think about this. How much more calmly would you trade if you knew that you had some sort of a steady monthly income from the market? So think about this. Let's assume it didn't matter how much money, whether you made money or not in any given month. Well, let's assume at the end of every month, someone were to give you 3,000, 5,000, 10,000 bucks, whatever the number is, regardless of how you did in the market, wouldn't you agree that you would probably approach the markets in a less nervous and a less anxious way? And wouldn't you agree that you'd be more prone to actually stick to your rules? Who'd agree with that? Again, right, exactly. So I see a bunch of yeses going in. And this is the point we're going to get to here. So, and by the way, it doesn't matter whether you're working part-time or full-time, or whether you're retired, or maybe you're soon to be retired. This is a strategy that's going to work for you very well. And I'll show you guys how and why in a minute. Let's take this to a bit more detail. So the importance of monthly or quarterly income, we kind of touched on it before. So whether you're stagnating in your account, i.e. you're just flatlining it, or you're losing money, what's going to happen over time is this. You're going to lose some confidence in the strategy, and ultimately even in yourself, which is completely not what we want. That in turn leads to you basically breaking rules, enforcing trades, and you're not sticking to any proper risk management, and it basically all goes out the window. And I know a lot of you guys can identify with that, and if you can't yet identify with that, at some point you will, and I'm trying to prevent that for you. So how does this sound? I'm going to show you guys a strategy that is, number one, it's very low stress, number two, high probability, and most importantly, and this is the most important point, it's very repeatable. It doesn't require a lot of time, and we're talking about profitability. So out of 10 trades, you should have about 8 or so being profitable, and the 1 or 2 losers out of 10 should not wipe out all those gains you just have in the past 10 trades, right? That second part is really important, because a lot of people can show you a strategy that is 80 to 90% profitable, but then that one trade that they do wipes everything out. And I'm sure a lot of you guys have seen that before. Well, at the very core of what we're going to talk about here today is this phenomena that happens every single day somewhere, of a steep slope that goes vertical. Right, you guys can see a very steep rally that ultimately goes vertical, and it usually never ends well, at least for a period of time. Or it happens to the downside as well, right? You can see a very steep drop that then goes into a vertical plunge. And at some point, whether it's a stock or an ETF or a currency or a commodity, you reach that point where it simply won't continue for a period of time. So, and that's really what we're looking for. So a couple of things happen when these steep slopes turn vertical. And again, the point here is the steep slope that turns vertical. So implied volatility tends to increase or become elevated. That's number one. Investor fear or greed reaches extremes. And what I'm going to call for right now the reward to risk for a counter trend trade are absolutely amazing. So let me just kind of walk you through what that is. Now, before we continue, I have one more question for you guys. Who in here has ever traded an option before? Give me a quick yes if you've traded an option before. Yeah? And by the way, it doesn't matter at all whether you've traded an option before. I'm just kind of curious how many people have. So a lot of yeses going in. All right. Now, if you have traded an option before, and I see a lot of yeses, then here is probably some statistics that you've heard before. But this is really important. The statistics I'm about to show you, they are technically true, but they are completely useless and untrue unless option selling is done the correct way. So here's what you've probably heard before. The odds are strongly in the option seller's favor. Maybe you've heard that more than 75 of options that are held to expiration expire worthless. So basically what this means is that if you are going to buy a call or a put, let's say, and you hold that option to expiration, there's only about a 25% chance of you making money. In other words, if you were to be a seller of that option and you hold it to expiration, you, by all else being equal, should have a 75% chance of making money. Now, again, statistically speaking, that's true. The problem is that unless you do this correctly, it is completely useless of a statistics, and you might as well not even know it. So that's what we're going to address today. People will also tell you that the longer you hold your short options, the better your odds of success. Basically, what they're trying to tell you is that you should play the theta game, the time decay game. And has anyone heard that before? You should be selling options so that your options expire worthless, right? Very, 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 very risky game, and we'll talk about that a little bit later on, right? So here are the 4 steps we're going to repeat together. And if you want to, you can take a picture of this slide or you can write it down, whatever you prefer. Number 1, we're going to look for steep slopes that have gone vertical and then give us signs of exhaustion. Secondly, we're going to ensure that implied volatility is elevated, or at least somewhat elevated. Thirdly, we're going to check for liquidity. This is just an obvious thing. You need to make sure you trade options that are liquid. And then very specifically, what we're going to do is sell what's called a far out of the money call or put spread using options that expire 2 or more months out in the future. Now, before some of you guys are probably yawning right now. I can already see, no, I've seen this before. This doesn't work. I'm going to make you a guarantee right now. If you've ever done anything like this at all before, I can almost guarantee you like 99% chance that you've never seen or you've never done exactly what I'm about to show you, because we see what's being taught and we see what people do, right? And they don't do what I'm about to show you. So please be patient, wait until I show you this. This is a huge differentiator between how most people do it and what we do, all right? So I'll promise you that. Now, again, what we're looking for is these very steep slopes that basically go vertical. But again, that vertical point on top of the steep slope is the important bit. And by the way, just as an FYI, there's a lot of charts right now in the market right now that look like this. Microsoft, for example. Anyway, again, or here in Netflix, for example, you can see very, very steep rally with a vertical blast off, right? So I'll show you guys in a minute how we find these points in time where the exhaustion gets clear, and I'll show you guys how we have a little bit of a tool that you can use for that as well. But let's first go to the concept and make sure you understand this. Again, what we're looking for is slopes that go vertical, because what happens is that the upside becomes capped or limited. And if the move is to the downside, in terms of the vertical move, then the downside becomes floored. In other words, the asset has a very strong tendency to then begin to stall. Does that make sense so far? Yeah, so that's what we're looking for. We're looking for assets that have a vertical move or a steep move that goes vertical. That vertical move is important. It happens, and you'll find these things every day, every week, every month. But they happen all the time. You got to just find them, and I'll show you how. And oftentimes, what happens is that you actually get a sharp mean reversion move to follow. That's kind of the bonus. We don't need that to happen, but you'll see how that happens. So here's what we're going to do. We're going to look for some examples right now, and I'm going to walk you guys through the concept first, right? So let me just be very clear what we're going to do. We're going to go through the concept first, so you understand what we're doing, and then we're going to go into the live market. So first, we're going to give you some historical examples so you understand the concept, because without the concept, we can't go into the live market. But then we're going to go into the live market in a bit, not right this second, but in a bit, so you guys can see that this actually works. I'm literally going to ask you guys in a bit to just give me ticker symbols blindly so we can look at them. Yeah, so that you can see that it works. I can prove it to you so you don't think it. So you see, I'm not just making stuff up here. So the first example we're going to look at is on the chart of Facebook, and basically, you can see that the stock had a very steep ascent at this point in time, and that it had these vertical moves. And as you guys can see, and again, we're showing you examples right now. Examples, historical examples. We're going to go to the live chart in a minute. These are historical examples to prove a point. We're going to go into the live market, okay? So again, you guys can see the steep moves that are happening here. And every time we had from a steep slope, a vertical blast off, what happened? We get mean reversion to the downside, right? But more importantly, the stock stops going higher. All right, so the stock begins to stall once the vertical move begins to happen. Make sense so far? So let me go give you some examples. Again, this is a historical example. This is not supposed to be live, this example. We're going to go into the live market shortly. I understand this example is from a couple of years, but that the point is to prove to you or teach you the strategy first. Does that make sense? It's really important. I can't go into the live market and show you something unless you understand the concept first. Okay, so here's what happened. This is the same chart that I'm going into an actual charting platform here to show you this. So you can see that the stock had a very orderly move to the upside, but every time it moved vertically to the upper end of its range, the stock started to stall. This happened once again here at this point in time, and at that point in time, there's a couple of things you could do. You could, if you get to that point in the market on the range, you could maybe sell the stock, right? You could, if you own the stock, maybe you take some profits. If you want to be more aggressive, you could maybe short the stock. Maybe you could even buy a put, right? But let me ask you this: if you were to short the stock here, at the upper end of the range after it's gone vertical out of an already steep move, or if you were to buy a put, who can tell me what's the one thing that the stock needs to do, must do, absolutely must do in order for you to make money? If you short the stock here or you buy a put, what has to happen to the stock? What has to happen to the stock in order for you to make money? What specifically has to happen to the stock? If you short it here or you buy a put, it has to go lower, down, right? If it doesn't go down, you will not make money. Does that make sense? It must go lower. If it doesn't go lower, in other words, if the stock goes sideways or higher, you will not make money. You'll lose money. It has to go down. So let's think about this though. At this point in time, what could this stock do, right? It could do one of three things at any given point, right? The stock could go sideways. It could go down, absolutely it could, or it could go higher. So it has three potential things it could do. But if the stock has to go lower, must go lower in order for you to make money, statistically speaking, all else being equal, what is the probability of you making money? If it can do one of three things, but it must go lower for you to make money, you have a 33.3% chance of making money, basically 1/3. In my world, that is not trading, that's gambling. Why? Because I'm looking for much steadier streams of income, for higher probability bets. If your stock must go down and you only make money if it goes lower, you have a 1/3 chance of making money. Give me a quick guess if that makes sense. This is a really, really crucial point, right? Now, instead of making these directional bets, what we like to do is we simply like to make a bet on where the stock is most likely not going to go. So I'll show you guys exactly what we do. So instead of making this directional bet, we are simply going to make a bet that the stock isn't going to go all the way up here, which is to say that the stock at this point in time, when it's already very overbought, right? It could go sideways, you make money. It could go lower, you make money. And it could even go higher up to a degree up to here, and you would still make money, meaning you have more than a 2/3 chance of making money. Okay? So what did we do? Instead of shorting the stock here, buying a put, we went what's called out of the money. So we went all the way up here and we sold a call. Okay, let me quickly go back to this. I now messed up the chart thing, so I have to bring it back. 1 second. Okay, so we made a bet that the stock at this point in time is simply not going to rally all the way up here, meaning it could go lower, it could go sideways, and it could go as much as 8% against me, and I could still make money. So what do? We sold what's called an out of the money call. So we sold a 125 strike call. So we sold a call up here, and we bought against that a call $5 higher. It's called a Berger call spread. It's super simple. You can do it with one click of the mouse on most broker screens. And in order to make that bet, we received $1 or $100 per options contract. If you do it 10 times, you receive deposited into your broker account $1,000. Well, in this case, the stock did actually go lower. And just so you guys know, I'll show you guys examples in a few minutes where that didn't happen, where the stock just went sideways and made just as much money. But in this case, it did go lower. And so a few days later, that spread was reduced down to 24 cents, meaning we got to buy back the trade and make 76 cents, i.e. $760 of profit, but the stock didn't even have to go down. It could have gone sideways or even against us a little bit. Okay, who can see so far, and there's a lot more to cover, who can see so far that this might just be a bit of a higher probability trade than you having to be not only directionally correct, but also direct in terms of your timing? If you want to generate income, I need to be very clear about this. If you want a steadier stream of income, yeah. Now, let me take this to another level right now, and this is where you guys really need to pay attention. So if you're doodling around on your phone, if you have lost your attention and you're emailing someone or Facebooking someone or whatever you're doing, please draw your attention back to the screen. This is I'm about to say the most important thing, to be honest with you. Okay, so who can tell me when we put this trade on in the month of February, what is the expiration month of the options we used in this example? And it's not an example, it's an actual trade we did. It says it right here, by the way. I want you guys to be able to pay attention. Who can tell me what is the expiration month? April, exactly. So let's recap. This is super, super important. In the month of February, we used options expiring in April. We didn't sell February options or any weekly options or something totally crazy like that. We didn't even sell March options. We used options expiring in April. Ladies and gentlemen, the very fact that we put on trades with options expiring somewhere between 45 and 75 days out, but we only hold these trades on average 1 to 2 weeks is literally the opposite of what almost everyone I've ever come across on the retail side does. On the institutional side, private banks, other institutionals, they do this all the time. I know it because I've been doing it for a long time. Okay, is this starting to make sense? And I'm going to go into why we do this. This is a very specific reason why, of course. So we sell options expiring, let's say 45 to 75 days out in the future, but we only hold those trades for an average of 1 to 2 weeks. We don't even get anywhere near expiration to hold these options. Let me walk you guys through why. This is really, really important right now, so please pay attention. Okay, so at this point in time here, let's assume instead of using April options in the month of February, let's assume we would have sold options that expired, let's say later on in February, like say 2 weeks later. Let's also assume the minute we put this trade on, the stock rallied a sharp 5% against you immediately. Who can tell me what happens to your P&L, your profit and loss? Any ideas? Yeah, you basically get your face kicked in. Right? So basically, I always like to use the car analogy. If you have a car with 4 wheels, most of us do, you just lost 3 wheels. You can't even push it back to the garage and get it fixed. You're just toast. You're done. You just took it in the face. Let's assume, however, that instead of using short-dated options, where you have no room for error, what if we used, like we do, in April options, right? If the stock immediately goes against you, let's say 5%, yes, you would still lose some money. Absolutely you would. But let's go back to the car analogy. What you would probably do is if you have a car with 4 wheels, you'd lose maybe 1 wheel. Meaning you take a manageable, i.e. small loss, you push the car back to the garage, get it fixed, and you move on to the next trade. Does that make sense? You have to use an anti-greed strategy if you want to have another source of income. All right, so I hope this is starting to make sense to you guys, and we're going to go look at a few more examples right now, and then we're going to go into the live markets. I understand these are old examples, but that's the point. The point is to make sure you understand the strategy before we go into the live market. Okay, let's look at another example. Here we're looking at a company called Tesla. You guys have probably heard of it before. And let's go through this example here. So what we're doing is you had, again, the same phenomena. You had a very steep drop off, and then a stock basically went vertical to the downside. Yeah. So at that point in time, the stock was so crazy oversold that we decided to make a quasi bullish bet. Let me walk you through this. So in the month of February, we used June options. June, guys, June. And basically, we said we sold an option, a put option, all the way down here. Then we sold another one further down it's called a bull put spread. Very simple. And in order to make that bet, we received $2.25 or $2,250 deposited into our account. Now, a few weeks later, the stock started to rally, and we managed to close that trade and keep the difference, meaning we made a profit of $1,820. All right, that's what we managed to do. And the crazy thing is, like I said before, the stock didn't actually have to go higher. It could have just as well gone sideways or even against us. Make sense? But again, the important thing here is that we use options expiring 45 to 75,000 5 days out in the future on average, but we sell, but we only hold these trades for on average of 1 to 2 weeks. That's like literally the opposite of most people do. Let's look at another example. Here is a company called LinkedIn, which in the meantime was bought out by Microsoft, by the way. We had a very sharp drop, then a steep vertical drop, and it became extremely oversold. Then what we did, same thing as we on the previous example, we sold what's called a bull put spread, and we sold a 90 strike put, I think about 10-15% below the market. We bought against it an 85 strike put, and we received 95 cents, i.e. $950 deposited into our account. By March 16th, all the stock had done is go sideways. That's all it did. It didn't do anything. It didn't go higher. It didn't go lower. And if at that point we would have closed the trade, we would have made about a $500 profit. And again, the stock didn't go anywhere. Conversely, if you would have bought the stock or a call, you would not have made money. In fact, if you would have bought a call, you would have lost money. The stock didn't have to do anything, right? Now, in this example, this is just for an example because this was done for one of our institutional clients. So he asked us to hold this trade until expiration, which we never, ever do. Okay, but I want to just show you for example purposes what could happen in a best case scenario if you do that. In this case, the stock basically just continued to go sideways, and the entire net credit basically was ours to keep, $950, and meaning the options are basically expired worthless. But we on average only hold these trades for an average of 1 to 2 weeks. Okay, now again, there's a lot of questions, and we're going to go through some of those questions in a bit, but we're going to go into the live market together right now. Now, one of the important things about this is that you have to think like a pro. What does that mean? The reality is that this strategy has an extremely high probability of making money. So this is not about having to pick winners, but rather it is to make sure you cut your losers, and we're going to show you exactly how this works, right? So doing this is going to just ensure that your winners and profits take care of themselves. It's just really that simple. And of course, there are going to be some losing trades, absolutely, and we're going to go through all this here right now in a minute. Now, what I really would like you to do is consider the credit spread as your regular income, right? The credit spreads is your regular income, because what you want to do at the beginning of every week, month, quarter, year is look for those credit spreads. That's the first thing that we do, is always look for that income-oriented strategy to basically lay a base of income, a foundation of income every month. And then you could do other stuff, and you could maybe, do additional swing trades or even some day trades if that's what you want to do. And I think that plus credit spreads is a very steady profit strategy. Now, of course, I mostly only do credit spreads anyway, and that works very, very well. Now, again, I understand the historical example that I showed you were just that. We just went over that 10 times. We're about to go into the live markets, okay? And do you guys so far understand the strategy? Give me a quick yes, because we're about to go into the live markets, yeah? I understand these were old examples, but that's the point. The point is to teach you the strategy. All right, cool. All right, good. So let's talk about this. Now, before we go into the live market, we have to play a little game that's called Follow the Indicator. And can you guys see those blue arrows on the chart? Yeah? All right. So what happens to the right of the last of the blue arrow? The stock went down. Yes, it went down. But much more importantly, the stock stopped going higher. Repeat after me. The stock stopped going higher. How about here in Alphabet or Google? What happened here after to the right of the last of the blue arrow? The stock, yes, it went lower, but more importantly, it stopped going higher. Repeat after me. It stopped going higher, at least for 1 to 2 weeks. Remember, that's our duration. That's our holding period for 1 to 2 weeks. That's all we're looking for. We want income, right? How about here in an ETF as well? Blue arrow, what happens to the right of it? The ETF stopped going higher, at least for 1 to 2 weeks. In this case, it actually ended up also falling apart, and that was nice. So having said all that, let's go into the live market. So what we're looking to do right now is to prove to you that this works, right? We're going to go into the live market. For those of you that were concerned that these are historical examples, let's go into the live market. Okay, so type in some ticker symbols that you would like me to look at, and I'm just going to take tickers, right? Type them in. So the first one here is from Mary, and she wants Intel, INTC. Okay, Mary whoop 00, and let me just bring it down. All right, so here's Intel. Let me bring it down. Mary, and I'm calling out your names by the way. The reason I'm calling out your names is not to put you in the spot, but just so you guys can see I'm not making this up. Yeah, Mary, this is for you. Blue arrow just printed a few days ago. Repeat after me, Mary. What happened since the blue arrow printed? The stock stopped going higher, correct? What would you do at that point? You would sell a call, you buy a protective call against it, you take in the net credit, you keep it on for 1 to 2 weeks, and you move on with your profits. Make sense? That was for Mary. Let's look at, let's see, how about Tesla? Sure, that's crazy enough. This is for Steve. Here's Tesla. This happened literally a couple days ago. What happened since the blue arrow printed? We're going to go into some stuff that's currently on the thing as well. What happened to Tesla since the blue arrow stopped printing? Now, this is a brand new example, right? So keep in mind, this literally just became valid like 2 days ago. But so far, the stock has stopped going higher. So what do? You sell a call, you buy a protective call, you move on. Make sense so far? Okay, more examples. How about Twitter? Sure. Twitter. Here, Craig, this is for you. Twitter, we just had an error print, literally just 2 days ago, right after earnings. And what would you do now? You sell a call, you buy a protective call, you take in the net credit, keep it on for 1 to 2 weeks, and you move on. And you can see previous examples. How about here? What happened after the arrows printed? The stock stopped going low. We're not saying the stock has to shoot higher. All we're saying is the stock's going to stop going lower for 1 to 2 weeks, right? Same thing here. What happened here? Stock stopped going higher. So you sell a call, you buy a protective call, and you move on. Can you guys see how this works? And I'm literally just taking your tickers, right? So you guys can see this. Okay. How about let's take some. Oh, how about AMTD? Sure, that's a good example yeah. Lenny, this is you for Ameritrade. Okay, can you guys see this? This is, by the way, this was I don't know if you remember in last October when Schwab started going with the commission-free for trading. What happened? Repeat after me. What happened after the arrow stopped printing down here? The stock stopped going lower. What do? You sell a put, you buy a put, you take in the income, keep it on for 1 or 2 weeks, you move on. What happened then subsequently up here? Once the arrow stopped printing, stopped going higher, right? For at least 1 to 2 weeks. You sell a call, you buy a protective call, and you move on. Make sense? Who can see that this may work? Anyone? Yeah, we're gonna go into some. If you guys want to, we can go into Does anyone want to look at an intraday chart, like a day trading chart? I'm happy to do that too. Silver, sure, let's have a look at silver. Some people are asking about gold and silver. So here's an ETF on silver. Last signal was here. Here's the last signal. And you can see you would sell a call, you buy a call, and you move on. Okay? All right. Intraday, yes, intraday, yes, anyone intraday? I just want to prove the point. I'm not going to do credit spread intraday, but I want to show you that the indicator works intraday. Yeah. So how about Apple? I think that's a stock everyone knows, right? You guys have heard of Apple before? Okay. Let's move down here. This is an intraday chart on Apple, 5-minute chart. The last signal was here, yesterday morning. What happened after the arrow stopped printing? The stock stopped going lower, at least for a bit, right? Now we're looking at intraday, right? We're not looking at daily charts. This is now you're looking at like a few bars, right? The stock stopped going low. So what do? You could make a bullish call. Or here, you got very overbought overnight, and you can see what happened, right? Or I don't know what else. Oil, sure. Let's look at an ETF on oil. Maybe that might be a bit easier. The last error. Let me USO Here, overbought. And then what happened to USO, the oil ETF? It stopped going higher. Or I don't know, NASDAQ 100, sure. QQQ, NDX, does that work? Does NDX work for you guys? NASDAQ 100? Yep. NASDAQ 100 here. This is the NDX. This is like the QQQ. Arrows yesterday morning. What happened after the arrow stopped printing? The stock stopped going lower, right? It bounced, and then same thing here again to the close. Can you guys see that this may work? Okay, let's look at a few more daily charts. I want you guys to see this. How about, I just want to make sure, I'm going to make stocks you guys actually know. Target, oh no, actually no, let's look at CTXS. This one's from Cliff, CTXS. Because I know we just did this one, so this is for you. CTXS, it's just printed about a week and a half ago, Citrix Systems. What happens, this is a daily chart, and this is the trade that we did. You can actually see it here. The arrow stopped printing, became valid here. You sell a call, you buy a call, and we actually already took profits on this trade. Yep. How about IBM? Sure. IBM, let's look at the last signals. We just did a trade on IBM actually. So this was the previous signal we had in July. What happened after the arrow stopped printing? It stopped going higher. You sell a call, you buy a call, you move on. It just happened again yesterday, actually. We put the trade on yesterday on IBM. This is just now. And you guys can see what happened. The stock stopped going higher. Make sense? Okay, now, if you think this is difficult, I'm going to show you guys how you can actually use a scanner for this. So literally all we do is we look for the opportunities here. So all we do is we have a scanner. We have overbought and oversold, right? So if you want to look for overbought signals, then you look at this scanner. It's literally one click of the mouse. Let me see if this is the right platform. Yeah, sorry. Let me bring this down. Yeah, this is the right chart. Okay, so all I'm gonna do is click on SYNA, right? So this is just, I'm just taking a random one here, right? And you can see we had overbought here. The stock stopped going higher, right? For at least 1 to 2 weeks. So you sell a call, you buy a call. And right now in the scanner, right now, this is what happened. It's not yet valid because we need a day when the arrow stops printing, which might have happened Monday or Tuesday or so. And that's what's on the signal right now. How about on the oversold front? Maybe, I don't know, let's just randomly take this one. Okay, you can see past signals, oversold, overbought. Again, for 1 to 2 weeks, it's all we're looking for. Now it's getting severely oversold. Can you guys see how that works? Who thinks this might work for you? All right, cool. All I did is take your signals, guys. That's all I did. That's all I did is take your signals. Excuse me, your signals, your tickers. Okay, so what you've seen here is this is a process that works. And so what I'd like to do is introduce you to what's called the options income secrets, because that's really why you're here today. You're here because you want regular income, and you want to know why and how regular traders like myself that have traded on Wall Street and other places, for now 21 years, how we're able to keep producing positive results on a month-over-month or quarter-over basis again and again. And so what I'm going to do is I'm going to give you the options income secrets package, so you guys can see how you can make this work for you. What are you going to get? You're going to get the monthly options income strategy that I just showed you today. That's going to help you produce regular income over and over again. I'm going to give you that low stress, high probability cash flow, i.e. income strategy. The benefit, you ask, is that it gives you steady and regular income into your account, meaning that now you don't have to second guess your trades, and meaning that you know every month that you have a reliable strategy to really put the odds in your favor and dollars into your account, basically, right? Now with this package, you will learn how to use options the way the pros do. The benefit is that now you start trading with confidence, and you start trading with a process, and it gets a little bit easier every day until it becomes second nature. I'm going to give you my cheat sheet so you're not alone. And the reality is that trading is all about a process, and I really can't emphasize that enough. So when you follow a cheat sheet, it's there exactly for that, to follow a process. And I want to give you that edge in the market, which is why I'm going to give you the indicator and the scanner as well. So this is not just about education. I want you to have an edge in the market like the pros do. And the reason why winning traders win like they do, it's not only based on knowledge. Now, I showed you guys before how super simple it is to use the indicator and the scanner with just one click. And basically what you do is you load the scanner, you load the indicator on your platform, and then you just use the scanner and click on the symbols. It works for Thinkorswim, it works for TradeStation, it works for NinjaTrader, and it works for TradingView.com. Now, if you have, say, Schwab or Fidelity as an account, or maybe Interactive Broker or something like that, what you can do is you can use a website called TradingView.com. You can create a free account, and then once you've downloaded and purchased the indicator from us, you can then just load it on there. We have videos how to do that. We can have people who can do it for you. It's very, very simple, and so you can do it there. So that's how that works. All right. So it works like this. Right now, well, actually, let's talk about the indicator a little bit more. So what makes the vertical export indicator so great is that it gives you access to the highest probability credit spread income trades. I'm going to give you a platform and a foundation that whether you are new to trading or whether you have been trading for a while, that you now have this strategy and you have this tool that you can rely on a month over month, a quarter over quarter basis to just create that regular income. That's exactly what this does, and I showed you earlier in the presentation, and I hope I've proven it to you by just literally taking your symbols. That's all we did. I took your symbols, I called out your names, and we looked at the stocks. Yeah. So I showed you the cash flow strategy. I showed you the simple and repeatable trade setups that you're going to get and have access to, and you can go over this again and again. It's kind of like a good book, right? So like one of my favorite books called The New Paradigm for Financial Markets by George Soros, and I read it basically once a year. And every time I go back, I pick up more stuff. So I'm going to give you everything that you need so you can also go back over it. So the way it works is like this. You're going to get access to a video course. You're going to get access to the indicator and scanner, and you're going to get access to live ongoing webinars. And that's the really important point. You can go to studytradersecrets.com/cash to get this. Let me just kind of walk through a couple more things here. Here's what some of the people are saying. Great strategy, great indicator. It's my bread and butter strategy from Jim. These are just things straight from one of our chat rooms that we have, and you can kind of see what people are saying here. Who's this not for? I don't think this is for people who are kind of swinging for the fences, right? This is probably only for people who are serious about actually having a strategy that has a more consistent approach, right? And you want to actually look for a more consistent type of income and another source of income. Now, Kathy actually said she's been using it for 10 days already and she loves it. Awesome. Thank you, Kathy. That's awesome. In the course itself, you'll learn everything you need to know about the strategy, why it works, how it works, and really even how to use implied volatility. You're going to learn, the most important thing you're going to learn here is how to turn this into a regular income machine. That's really the most important thing. And we're going to teach you how to diversify this among different strategies, across different sectors and industries and asset classes. We'll teach you where to take profits, how to risk manage this, and everything in between. So again, you can go to studytradersecrets.com/cash. I'm going to quickly type that into the chat box here. Let me see. Yeah, studytradersecrets.com/cash. Thank you. I think they already typed that in. So what are you going to get? So if you were to get the course itself only, that would be $199. If you wanted to get the market scanning sessions, which I'll go through in a minute, these are ongoing market scanning sessions we do for members, that would be $497. If you wanted to get the indicator and the scanner, that would be $1,997. And we have a brand new Iron Condor module as well. That's basically priced. So the total package value is $2,693. For the next 25, and we really mean that, it will shut down after 25 people. We're going to give you a 90% off today for only $297. That's a one-time payment. It's not a recurring fee. It's not it's not a monthly fee. It's not an annual fee. None of that. It's one time. You get the indicator, the scanner, the course, and you get the ongoing live market scanning session, which I'll talk about in a minute. Now, again, you can go to the studystrategies.com/cash. Let's see here. The next live market scanning session happens next week, February 13th at 10 a.m. Eastern, 7 a.m. Pacific. These things are always recorded, and you don't have to worry about missing out on these things. We do them all the time. What do we do in those sessions? Number one, we teach you how to use the indicator, right, in detail, and how to use the strategy, how to use the option strategy. And secondly, we're always going to look for actionable ideas. So we just did a session, literally just did a session 2 days ago, and the actionable idea we gave people was in IBM. Okay, so just so you guys know, we also give you live actionable ideas in those sessions. Now, let me be very clear. We do these sessions at least every other month. At least every other month. We have done, just for the record, I think we did about 17 of them, of those sessions last year, so we did way more last year, and already this year, we've done 3. So we're gonna continue doing a lot of these, but on average, we promise you we do at least one every other month. But again, right now we're kind of on a tear because we want people to really get up to speed this year. We've done these for years, so this is not about a one-time thing. This is about an ongoing thing, right? So you become a member of this, you get the indicator, the scanner, the course, and you get to join the live market scanning sessions. Does that make sense? Let's see here. Again, Kathy, thanks for the testimonial. That's awesome. No, if you have there's no additional fee. So what happens is you get the indicator and you can install it. So like, for example, what happens once you join, you're going to get access to the website, and then you're going to go to indicators, TST Vertical X Pro, and then all you do is you look for the platform, right? So let's say you have Thinkorswim. There's a little video of how to install it and how to install it using the Thinkorswim scanner as well, right? We have a great team that can help you do this. There are videos on the websites. And again, the next live market scanning session takes place February 13th at 10 a.m. Eastern, 7 a.m. Pacific. Again, these things are always recorded. We've done them for years and years and years. So this is an ongoing thing. This is not just a one-time thing. But again, you do have to be one of the next 25 people if you want to get the 90% off. After that, the price will go back up. And so right now it's only $297. You get to keep this. This is there's no license here. You just keep it. Like, you're a member and that's it. End of story. Yeah. This is for Martin asking that question. I know I probably have to wrap it up here, Jeanette, but let me just go through a couple more questions here because I know there's a lot of questions. Again, Kathy, Kathy said just a minute ago, she has been using it for 10 days and loves it. The scanner really works. Thank you so much. Appreciate that. On the intraday charts, well, on intraday, again, we're going to teach you all this kind of stuff in the live webinars, right? So that's why we do live webinars all the time. We go through a lot of effort to teach you this. Any questions you have about risk management, reward to risk? A lot of you guys are asking about reward to risk on this. I will teach you all of that, and I'll tell you why reward to risk. Oh, Siri is talking to me. Well, we'll tell you why reward to risk is what I would say the wrong way to look at this, right? Again, about entering trades, exiting trades. That's why we do the live webinars, right? So you get this. We do these live webinars all the time, right? It doesn't stop, basically. Make sense? Who thinks they can make money with this? Let me ask you one more time. You guys, I think you've seen that it works, right? So we just had a trade trigger in IBM the other day. We had another one trigger in CTXS. What is it? Citrix Systems. Just so you guys can see, I'm not making this up. This is it's just here. Cool. All right. I think with that, Jeanette will pass it on to you so we can, you guys can stay on schedule. But thank you all for joining. If you want to join again, you just have to be one of the next 25. That's all, if you want to get at this price. And with that, have a great weekend.